Welcome to the Deep Dive. Today, our mission is pretty focused. We're diving straight into one of the biggest, maybe most feared acronyms from the 2017 Tax Cuts and Jobs Act, GILTI.
GILTI, Global Intangible Low Taxed Income.
Exactly. We want to give you the essential what, why, and how on this, what you really need to know to spot this for your business clients.
And it's critical we do, because GILTI, well, it's found in Section 951A of the Code, but it's not just some minor adjustment, it's a completely new anti-deferral rule.
Right. It changes the whole game for U.S. shareholders with foreign operations.
Specifically, controlled foreign corporations, CFCs, it fundamentally alters how they're taxed.
Okay, so let's unpack the why. Before GILTI, before 2018, U.S. companies had this big advantage, right? Deferral.
That's the key word, deferral. They could set up subsidiaries, say, somewhere with low taxes like Ireland.
And just pile up profits there.
Exactly. Especially profits linked to intangible assets, think patents, IP, brand value. Easy to shift legally, hard to tax back home until the money was actually repatriated.
Which often meant never. Trillions kept offshore.
Correct. So Congress wanted to stop that. GILTI is really the TCJA's main weapon against that kind of indefinite deferral, particularly for intangible income.
So how does it stop it? What is GILTI then? Is it just taxing money when it comes back?
No, that's the crucial shift. It's an immediate tax. It forces what's called a deemed inclusion.
Deemed inclusion, meaning you pay tax now.
Yes, now. On certain foreign earnings, even if not a single dollar is brought back to the U.S., the income is deemed to be distributed to the U.S. shareholder.
Okay, so which earnings? Is it all foreign profit?
No. And here's the, well, clever or maybe controversial part. The law basically assumes a normal business should earn about a 10% return on its tangible assets.
Tangible assets. Like factories, machines.
Yeah.
Stuff you can touch.
Precisely. So the calculation looks at the profit above that 10% return on tangible assets, that excess amount. The law presumes it must be profit from intangibles.
And that excess is what gets hit with the GILTI tax immediately.
That's the core idea. It's effectively a tax on what the code defines as excess foreign profit, linked implicitly to intangibles.
Got it. So it's like a filter based on physical stuff.
Yeah.
Let's talk about how that's calculated then. How does it work mechanically?
Well, the starting point is aggregating the net tested income from all the shareholder CFCs, basically their relevant profits.
Okay, all the profits pooled together.
Then you subtract the carve-out. And that carve-out is the 10% return on tangible assets we just mentioned. The technical term for those assets is QBAI.
QBAI, Qualified Business Asset Investment.
Right. Depreciable, tangible property used in the foreign business. So net tested income minus 10% of QBAI equals your GILTI inclusion amount.
Let's use an example. Say a CFC makes $1 million profit, and it has $3 million worth of machinery. QBI.
Okay, so 10% of $3 million is $300,000. That's your carve-out.
So $1 million profit minus the $300,000 carve-out leaves $700,000.
That $700,000 is your GILTI inclusion. It's income the U.S. shareholder has to report now, even though it's still sitting in the foreign company. It feels like ghost income to the client.
Ghost income, I like that. Okay, reporting. This sounds complex. What forms are involved? This seems like a penalty trap waiting to happen.
It definitely can be. The linchpin form is really Form 5471. That's where the underlying data comes from, the tested income, the QBAI figures for each CFC.
And the penalties are serious.
Very. Failure to file Form 5471 correctly starts at $10,000 per form per year. It can escalate dramatically.
Wow. Okay, so 5471 feeds the data. Then what?
Then you use Form 8992. That's where you actually aggregate the numbers from the 5471s and calculate the final GILTI inclusion amount. That's $700,000 in our example.
Got it. 5471 for data, 8992 for the GILTI calculation itself. Is there anything else? Any relief?
Yes, for C corporations, there's a really important piece, Form 8993. This form calculates a special deduction under Section 250.
A deduction, how much?
It allows C Corp to deduct 50% of their GILTI inclusion. So in our example, 50% of $700,000.
So $350,000 deduction? That significantly softens the blow.
It does. It effectively brings the U.S. corporate tax rate on that GILTI income down to 10.5% at current rates, before considering foreign tax credits.
Okay, 10.5% effective rate for C Corp. And where does this final GILTI number, after the deduction, actually show up on the tax return?
For a C Corp, that net GILTI inclusion lands on Form 1120, Schedule C, line 14.
Right there on the main corporate return. Okay, let's wrap this up. What are the absolute must-remember takeaways for someone listening?
I'd say two main things. First, always ask business clients. Do you own any part of a foreign company? Any percentage. It triggers the analysis.
Don't assume it's too small to matter.
Exactly. And second, hammer home that GILTI is about immediate deemed inclusion. It has nothing to do with actually bringing the money back to the U.S. The tax applies whether the cash moves or not.
Deemed inclusion, not repatriation. Got it.
And maybe one final thought, connecting back to that QBAI calculation. Think about why a client with a huge foreign factory, lots of tangible assets, might have a smaller GILTI problem.
Because they get a bigger 10% carve-out.
Precisely. Compared to maybe a client whose foreign subsidiary is just, say, a sales office holding valuable IP but with very few physical assets. That QBAI shelter, understanding that tangible asset base, is absolutely key to structuring global operations now.
That really highlights the incentive structure built into the rule. Fascinating stuff. Thanks for breaking down GILTI for us.
You're welcome. It's definitely a complex area, but crucial to understand.